Welcome everybody to the first episode of the Global Investor Podcast. Now, of course, this isn't technically a podcast. I will be videoing it and throwing it up on YouTube. I want to include charts and graphs and make things a little easier for people to follow. But, podcast is the buzzword these days, so I'm going to go ahead with that. Now, I'm not sure what format I'm going to go with yet. It may be one segment, I'll choose a topic, talk about it for, 10-15 minutes, or I might actually try to splice things together in more of a segment format, where if something interesting happens on Tuesday, Wednesday, I'll shoot a 5-minute segment, Thursday, Friday, add a few more, and put it together that way. So it is a work in progress. And also, please forgive the rather unpolished nature of me on camera. It's not technically live, but this format is somewhat new to me. You might think because I've got so many videos up on YouTube already, I must be very comfortable on camera. That's actually not the case at all. I've always had a fear of public speaking, always been nervous on camera. Even right now, in my own home, there's nobody watching. I'm still feeling a little bit nervous. So it is a learning curve, please forgive that. Not quite as easy as it looks. Now, other places you can follow me. Of course, my YouTube channel, like I mentioned, you can check out those videos. Please leave feedback. You can email me and ask me to make specific video topics for you. I like doing that, answering from the community. I'll leave my Twitter handle for you. I'm not super active on Twitter, but I try to include a lot of useful information as markets are moving throughout the day. And I do have my other business, Volatility Trading Strategies, which is my primary business. But I do want to try to separate these two. I want to keep my VTS community somewhat separate from the podcast. Of course, naturally, a lot of it will bleed in, but I will try to separate those two things. But you can sign up for the community. I do a daily blog, do daily emails, do a lot of videos for people, and I also talk about what positions all of my trading strategies are actually in. So, people can get a glimpse of what I'm actually doing with my live trading. So feel free to sign up for that. I'll leave links as well. But basically, this is the first episode of a work in progress. I'm hoping it'll be a somewhat regular show. No guarantees, I am quite a busy person. But, weekly, bi-weekly, I'm really not sure yet. But please leave feedback. Like I said, this is a learning process for me. I do have thick skin, so leave constructive criticism. It'll really help me get over some of the initial hurdles, I'm sure I'll fix it all myself as we go, but it'll be a whole lot faster if you help me. So go ahead and leave comments in the comment section below. But that's pretty much it. Thank you very much for giving me the opportunity to do this, and let's get into the first episode of the Global Investor Podcast. So it was a pretty crazy week in the markets, and actually all of December has been pretty insane. I've got a few numbers in a minute to show that. But it was an event-packed week. There was a pretty substantial overlay of political events going on. There was some legal issues discussed within the presidency, key people leaving. It was pretty exciting stuff, but I do like to leave politics out of things as much as possible and just focus on things we can actually quantify, actual events that did happen, and maybe we can get an idea of how they're going to affect the markets going forward. So the one thing we of course do have to talk about is the Federal Reserve did end up raising interest rates. You can see here this is the federal funds rate since January of 2000, and right here is that very long extended period of basically 0% rates. Totally unsustainable, of course, but considering the magnitude of the financial crisis, probably necessary. But at some point, rates do need to be normalized, and this is now the 9th time we've seen rates being raised, 4 times this year, which I actually support this policy. I think that it's a good thing. The economy is pretty strong, the employment picture's good, the earnings are still coming in, everything seems to be fine, so there's no reason not to continue normalizing rates. If the economy can't sustain a 3 or 4% interest rate, then obviously it's not very strong to begin with. I don't think this is the reason why markets are crashing. I think it's probably just one of many. There are certainly a lot of headwinds out there and just a ton of uncertainty. But as far as interest rates go, it's pretty well telegraphed ahead of time. The probability, the market's expectation for a rate hike was very high, so this didn't take anybody off guard. I don't think that's the reason markets are selling off. Really, the only interesting thing happening here is the divide between President Trump and the Fed Chair Jerome Powell, which even before this rate hike, there was chatter that his job may be in jeopardy. And certainly after he raised rates, basically against the explicit wishes of the president, we may actually see some acceleration there, and perhaps some action taken. So that will be something to keep an eye on. But as far as rates in general, I think 4 this year was probably the right thing. I would like to see 2 or 3 next year. We're really not sure yet. The language has changed a little bit, but we just have to continue normalizing rates, and hopefully the economy is strong enough to maintain its course. The other major event that we need to talk about is the government is shut down now. Now, that sounds terrible, and it really is. It's a total failure of government. That's essentially their only job, is to negotiate and compromise and make sure both sides get what they want and make sure that the government stays functioning, at the very least stays open. So it's bad, certainly optics-wise, it's terrible. And it'll probably be a little bit inconvenient for a lot of people, which is unfortunate. A lot of the essential workers, they will have to stay on. They can't just leave, of course. About 80% of the country is totally unaffected by it. But the 20% that are affected, some of them might not get paid. There may be closures. There may be, reduced hours and all that stuff. It's not a good thing no matter what. But I have a chart here showing that it's also not that uncommon when you really look at it. These are all the shutdowns since 1975. Carter administration had plenty of them. Reagan administration had a bunch. Bill Clinton had his famous shutdown over Medicaid. Barack Obama had his over Obamacare. And now Donald Trump has had 3 of his own. Now in this column here, the number of days, you can see sometimes they last quite a while, 2 or 3 weeks. Other times they're very short-lived. Donald Trump so far, 3 days, 1 day, not really a big deal yet. It's essentially just political posturing on both sides. I'm not trying to be partisan here. It's both sides. They're trying to get what they want. They're trying to impress their base. It's really quite silly. But the only thing I will say about that, whenever you have one party that's in control of all aspects of government, it is a little bit more difficult to convince the public that it's the other party's fault, because negotiation and bringing people together, that really is their job. You can't just sit back and say, well, we don't have the votes, so therefore it's shut down, and it's their fault for not agreeing with us. That's a little bit more difficult to make a case for when one party has control of everything. And in this case, certainly it's not helping President Trump's case, because he did go on national television and say that he will take responsibility and essentially he'll shut it down over immigration. So again, not being partisan here, I don't want to comment on immigration. Obviously, countries need borders. You can't just come into a country and live there legally and have everything just fine. Something needs to be done, but it's the government's job to make sure that both sides get a little bit of what they want and really just make sure that the government doesn't shut down. So this column over here, you can see, this is the actual effect on the S&P 500. I've compiled all the data for the various shutdowns. You can see sometimes markets do crash a little bit. Other times the markets go up. It's really kind of just random. The overall effect, 0.5% down, it's really not a big deal. So again, this is not helping the situation with the S&P, but this isn't the sole reason that it's going to be crashing. This is just one of several layers of uncertainty right now, and we will certainly keep an eye on this going forward. But getting into the wild and crazy action in the markets, this is the S&P 500 for this year. The start of the year is right there. I drew this white line right where it ended on December 29th, 2017, and that's here. So right here is the start of December. This is right here. This is November 30th, and it's just been a steady crash in December. It's actually been a pretty impressive decline. I've got a couple of charts here showing that as well. This first one, these were, I found these on Twitter from one of my favorite follows. If you're not following Odd Stats on Twitter, you definitely have to. Log into Twitter, give him a follow. He publishes a lot of these really interesting charts and statistics. A lot of them are just kind of whatever stats. If the S&P is up 1% on Monday, Tuesday, Wednesday, and it's down 1% Thursday, what happened the week following? Really kind of weird, obscure things. But, he also does post a lot of really cool stuff too. And this is showing that. So the worst Q4s in SPX history. You can see where we're at right now. This is October, November, December. We're not quite done yet, but it's actually historically bad. You'd have to go back to the Great Depression here, Black Monday. It's pretty ugly. And then as far as worst Decembers, just on its own, we are closing in on what would be considered the worst December in S&P 500 history. So this is not good. Another way to look at this, another interesting chart here. This shows all of the asset classes and how many of them are negative for the year. So negative asset class returns, you can see 2017 here, almost nothing. Last year, everything was up even a little bit, 1% here, 2% there. A lot of things were doing better than that. But you can see just the stark difference in 2018. This is pretty insane. There's never been a year in history where more asset classes have been showing negative returns. And this 90%, it's actually up to be about 93, 94% right now. So an updated chart is going to look even worse here. It has been an absolute bloodbath. That's a word that I'll probably use several times during this podcast. It's been a bloodbath. A third way to look at this, if you're not totally convinced that things are not looking very good, this is a chart that I put together. This is the ETF stock market performance for all of the major countries in the world, organized because I wanted to, you have to figure out a way to rank them all. It's also useful just to see GDP rank. I have them all ranked 1 to 40 based on their GDP for 2017. And it's not very difficult to see what's going on here. Pretty much everything is negative. And these are not just negative by 1 or 2%. 40 countries in the world. Iran doesn't really have an ETF to track. Saudi Arabia, for whatever reason, is up almost 7% this year. But 38 out of 40 countries ranked by GDP in 2017 are down this year, and down big in a lot of cases. You can see in the United States, down 9.8, that's not that bad. I'm a Canadian, so here, shout out to my fellow Canadians out there. Hopefully, my Canadian friends found a way to tactically move to cash or to other assets that aren't crashing, because that's pretty ugly, down 20.95%. But many countries are in that situation. Right here, we've got the Vanguard Developed ETF, the VEA, down 18.37%. Developed countries are nearly in a bear market. We've got the iShares EEM, emerging markets, again, almost in bear market territory. This is really not very good. It's actually been a pretty disastrous year for stocks all around the world. And like I just showed, not just stocks, but pretty much every asset class. There has been very, very few places to hide to get any type of rate of return this year. And the last thing I'll talk about really quickly, these are the ones that I focus in on quite a bit, because my tactical balance strategy within the other business that I mentioned, Volatility Trading Strategies, this is my core strategy where I'm tactically rotating between 3 possible positions. That's either MDY stocks, IEF bonds, or GLD gold. So these are the ones that I tend to focus on the most in my trading. So we've got MDY getting crushed. Bonds have actually turned very slightly positive this year, and gold is down. But if you were to have a 50, 25, 25 fund, you can see, again, the results have been pretty poor. So not a whole lot more to say on that front. Obviously, 2018 has been a complete disaster for a lot of investors out there. And December, specifically, will definitely go down in history as one of the worst months we've ever seen. Now, we have to take that into context a little bit, because although it doesn't appear like it, the bull market still actually is intact. So it's not like it's the Great Depression where people are lining up for food and, as they say, blood in the streets. It's just asset prices are really getting hammered right now. And like I said, there's many layers of reasons for this. It's not just interest rates. It's not just the government. It's not just the president's legal troubles. It's not just the fact that the bull market has in fact been going for 10 years, and it is now either the second or the longest, depending on how you qualify that. It's been a very long bull market. There's a lot of things going on, but we will just have to wait and see how this all ends up. Right now, it is the end of December. Maybe there's some type of relief into the new year. Obviously, the markets don't care whether it's January, December, or June. The calendar year has no effect on anything, but maybe just psychologically it might actually kickstart a few things. I don't really know. It's been interesting. For me personally, I've been holding a lot of cash positions, a lot of bond positions. I've done okay investing wise. Up on the year, things are going, it's nothing to write home about, but as far as the relative performance, quite good still. But, even the fact that I'm not losing money, I still want to be sensitive to the fact that this is fairly terrifying to watch. I mean, the S&P dropping 14.5% in a single month. There's a lot of people losing money. There's a lot of people scared. Nobody really knows what to do. It's tough. I mean, I feel for you for sure. And just remember that cash is an active portfolio position. You're not in cash because, boy, I have no idea what to do. I'm just going to sit in cash. It is actually a portfolio position. Sometimes cash is the best asset class to be in. So just keep that in mind. But that's the market recap. I'm sorry it's so grim. It's a few days before Christmas. I wish I had better news. But what a disaster this year. A bloodbath in the markets. So now I want to get into some volatility specific talk, because for me personally, this is the most important aspect of the market to understand and to utilize in the rest of my trading. So even when I'm not trading volatility products specifically, maybe I'm just trading stocks and bonds or figuring out when to move in and out of gold positions, I'm still using volatility metrics to guide those trading decisions. So very important for me and for my trading. In future episodes, I will go through some of these. I'll do a deeper dive and talk about each one of them individually. But for right now, let's just focus on one that everybody knows and loves. It's the VIX index. So here's the VIX here for 2018, and right away you can see there's been two separate areas of elevated volatility. So the first one back in February, this was the famous Volpocalypse, the Volmageddon event, where on February 5th, we saw the VIX index spike 115% in a single day. That was the largest by far going back to 1990. And anybody who trades volatility products specifically, they will remember this day forever, because of course it was also the day that we lost one of our favorite products, the XIV. And then more recently, in the last few months, we've seen some elevated levels of volatility as well. Now, for me personally, I think the story late in the year is just how muted volatility has actually been. Now, I know that sounds a little strange. The VIX is at 30. That's certainly an elevated level, but I would say that it's a little bit undershooting what's actually happening in the markets, and I want to give a few examples of that. Now, I've seen a lot of commentary out there saying that because this sell-off we're seeing is actually fairly orderly, which I suppose you could make a case for. It's basically just down 1%, down 2%, pretty much every day consistently, minus a few in between. So I suppose you could say that because the historical volatility is also quite low, the realized volatility, that therefore implied volatility is actually in its normal range. But let's just do a few comparisons here. So this box right here, this pink line, the historical volatility 20, and then below it is the implied volatility. So let me just find February 5th here, which is right there. You can see the historical vol, the 20-day, is 19.08, and the implied vol just below it, that turquoise line, is 46.83. So implied volatility is comfortably more than double the historical volatility, which is kind of normal. That's what you see. When markets are panicky, of course the implied shoots up very quickly, but the historical takes a little while to catch up. So this is a normal risk premium that you would expect during a crisis. But now when we look over here, let me just highlight December 21st. Again, looking at the same numbers, the historical vol 20-day is 22.98, and the implied volatility is only 30. So this is substantially lower than the normal risk premium we would expect given a crisis level. So as far as the relationship between IV and HV right now, it's not really reflecting that panic yet, which to me has been a little bit surprising. And there's another way to look at this as well. This yellow line down here, ATR 14, this is the average true range. So I think people should pay attention to the average true range. Add it to your software. Take a look at it from time to time. What it essentially is imagine the S&P 500 opens flat. So let's say 2600, it opens. And then it rockets higher intraday, maybe 2 hours later, it's up 2%. And then something happens later in the day, intraday move, it's back down to zero. It retraces all of those gains, drops 2%, and it's right back to where it started. Now, if you were to turn off your computer in the morning, maybe you take your family out, you take them to the zoo or something, you look at your phone, and you see the S&P at market close is flat, you may think nothing happened. But actually, it's a 4% intraday move, which is a very violent reversal in the market. So that's not often reflected in some of these other volatility metrics that we see. So average true range is actually a very important metric. And again, let's do some comparisons. So February 5th, we can look at that yellow line, ATR, is 33.25. So this is to be expected because it was sort of a sudden event. You can see back here it was pretty calm. So the average true range over a 14-day period, yeah, it's not going to be very high. But you can see even after all the violent moves, it peaked at 62, which is legitimately high. And that's why volatility was so high. That's why historical was so high. And I would say that overall, this is the volatility levels we would have expected. The backwardation levels in the VIX futures term structure, all of the metrics that we track were fairly well expected and accounted for back then, the VVIX as well. But when we go over here, December 21st, again, we see the ATR, the average true range, at 66. It's higher now than it was back in February. And if I back out for you even 5 years here, we can actually see, relatively speaking, that is a major, major market move. Right here in beginning of 2016, this was left over from the 2015 move, but actually this down period to start 2016 was actually the worst calendar week on record for the S&P as well. The average true range topped out at 45. And then you can go back here, topped out at 52 during the 2015 crisis. Let's go back even further just to get that 2011 debt crisis. So if we go back to 2011, you can see the average true range topped out at 44. So where we are now, hitting levels of 66, these markets are moving more than at any other time since the financial crisis. And yet, we still see the VIX index just managed to top 30.11, and this only happened in the last day. Surprisingly, volatility has been quite muted during this move. There's another way we can look at this quickly as well, using percentile rankings. So what I've got here is the percentile ranks for all of December as a mean, and then just December 21st as the worst day. The VIX futures M1, M2, this is the common contango backwardation levels that we track. I would certainly have expected to see it much, much lower than it is right now. The average mean for December at 8%, which means there's been plenty of periods where it had higher levels of backwardation. And even looking at it right now, it's minus 5.5 or so. There's been plenty of periods where it's lower than that. The VIX is even closer to normal levels. I mean, 81%, 19% of trading days going back to 2004, or actually I think I dragged this back to 1990, 19% of days having higher values than we see right now. That's a little bit strange considering the average true range. And lastly, the VVIX, the vol of volatility, again, it's even lower than the VIX. This is very abnormal levels. Let's take a look at that on a chart as well, and it becomes pretty clear. So you can see here the VVIX, it's actually kind of in normal levels. The long-term 5-year average mean for the VVIX is 93. And the average for December was about 95. So honestly, it is way undershooting what we would expect. If you would have asked me a few months ago, what level of the VIX do I expect to see given the S&P 500 is about to see one of its worst quarters in history and the second worst December since 1931, what would the VIX touch? I would say, well, during the flash crash in 2010, it nearly got to 50. It was at 48. During the debt crisis in 2011, it got to 48. During 2015 crisis and into 2016, topped out at 54. We saw it over 50 in February of 2018. Given the fact that the average true range, the markets are actually crashing and moving around more than they have at any other time, I would say, yeah, the VIX should be in the 40s for sure. And it would not surprise me at all if it touched the 50s, maybe the 60s. So it's a little weird that the panic really hasn't set in. It has been fairly orderly, and this is one of the reasons why I've not gotten many long volatility signals in my strategies, because these metrics have not degraded down to the levels I would have expected to see. I don't make trade decisions based on what I think the markets are going to do. None of my market predictions are factored in here. I'm just looking at the numbers. And the vol metrics that I use, to get into long vol, I need them to be, anywhere from the 0 line, which is the most degraded that they can get, maybe up to about 3, 4, 5%. And right now they're all at about 8 to 10, sometimes even 12 or 13%. So volatility markets have not degraded to the point that, for me personally, would justify long volatility, which again is shocking considering what we're seeing. The S&P drawing down more than 15%. I think it's at 17% from its high. So pretty strange, but we're just going to have to wait and see what happens. You know, it's a short week coming up. It is Christmas. Maybe the selling pressure is over. Maybe it's not. I really have no idea, but it's going to be a very interesting week, and I'm very much looking forward to it. So I think I'm going to leave things there for now. This is a learning process for me. I'll upload what I've got, take a look at the footage, and hopefully figure out my next move. But I've got a lot of good ideas for future episodes: stocks, volatility, options trading, investor psychology, budgeting, figuring out how to structure your life and your schedule to be a trader, all kinds of stuff. So hopefully by episode maybe 5 or 6, I'm getting a little bit better at this and everybody can enjoy the show. But like I said, please leave constructive criticism. It's definitely helpful for me. Tell me what you liked, tell me what you didn't like. It'll really speed up the process. And lastly, follow me on Twitter, subscribe to my YouTube channel, and if you are interested in seeing what I'm doing with my actual portfolio, you can also check out my website, Volatility Trading Strategies. You can see what I'm doing with my live trades. But thank you very much for watching. Of course, Merry Christmas to everybody. I hope you have a great week with your family and your friends. Not everything is investing. Try to get your mind off the markets for at least a week. Hopefully the selling stops and everybody can kind of relax a little bit, but we'll just see where we land this week. Thank you very much for the support, and I'll see you next time.